Money Show.
Personal Finance with Warren Ingram.
And Personal Finance is brought to you by IG Markets. IG Markets South Africa is an authorized financial services provider. CFD losses can exceed your deposits. Good evening to Warren Ingram, who's a personal financial advisor and also the executive director at Galileo Capital. It's been a while, Warren.
It has, Ray. It's great to chat to you.
Absolutely. I love the topic tonight. Why is smoking or eating junk food the same as investing all your money in cash? Do tell us.
So I think it's about the kind of risks that we're taking when we're, if you smoke or eat junk food over long periods of time. And to me, that's called a slow risk because, if you eat, really lousy junk food, every day of your life for 20, 30 years, there isn't going to be, one burger or, one piece of fried food. I'm so careful not to say companies' names here, but you get my gist. There won't be one meal that you take that actually makes you sick or gives you heart disease or, diabetes or something like that. It will be a collection of decisions that you've taken to eat that food and to have those meals day after day after day for long periods of time. And eventually, you are nearly certain to develop some kind of health problem. It might not be something that, that's completely fatal, but it is absolutely guaranteed to give you health issues. And in life, that's considered a slow risk. A fast risk is something that's really obvious. It's for example, it's not wearing your seatbelt, borrowing too much money or cheating on your spouse. All of those are going to have immediate consequences if something goes wrong. If you don't wear your seatbelt and you have a car crash, you're going to have an injury, you might die. Cheat on your spouse, you're likely to get divorced or get into serious trouble. Borrow too much money and you're going to go broke. Those are fast risks, and those are things that because the consequences are so immediate, we tend as human beings to be programmed to avoid those risks. Most normal humans anyway would avoid those risks. And so if we look at the world of investing, I would consider a fast risk to be something like, buying an investment like, in the stock market where, our job, I guess, when we're talking about things is to talk about stock market crashes, for example. It'll be a topic in the media. It'll be a topic among our friends. And that will be the same as a car crash. It's attention grabbing. The consequences are immediate. And so for most of us, we would say, well, hang on, that's not something I want to expose myself to. I'm going to wear my seatbelt, and the equivalent of kind of avoiding, the fast risk in the investment world is to put your money in the bank, or even worse, put it under the mattress. And then you feel completely safe because, day after day, you're just getting this, little bit of interest and there's no big fast crash going to happen. So you feel absolutely safe. And as the days and weeks and months go by, everything seems fine because nothing's ever gone down. You haven't experienced any kind of a big crash. Unfortunately, that's the same as eating the junk food day after day after day, or having packets of cigarettes day after day. There isn't going to be the one day that really alerts you to the problem that you've created for yourself. But the longer you do that, the longer you keep your money in cash, and the longer you avoid investing in shares and productive assets, the more likely you are that you're actually injecting your investments with the slow poison. And unfortunately, that's interest on cash. Because, cash just doesn't generate a return once you've taken inflation into account. So if you're earning 4 or 5% a year on your money at the moment, just understand that, if inflation's running at 3, 4 or 5%, and you take some kind of tax off the interest that you're earning, the likelihood is that you're actually going backwards, every year, once you've taken inflation and tax into account. And, you do that for a decade or two, and unfortunately, your money is depleted. You might still have cash, but what you've lost is the buying power of that money. It's just absolutely gone.
Yeah. Warren, how are we looking then with our rand? Now, talking about cash, and I see what you're saying. Don't just have cash because it depreciates, et cetera, but would it not be a good idea to perhaps buy pounds or dollars or somebody else's cash because our rand's not doing too well?
Our rand's not doing too well today and maybe this week, and potentially for the month of November. But just rewind to let's say March last year, and there the rand was nearly 17 to the dollar, and so we must remember that the rand is just by its nature a very volatile currency. So it does go shoot up, and then we all panic because it's now at 17 to the dollar. Then it starts to strengthen. It doesn't do it in the same way and at the same speed as it weakens. But what's interesting about the rand is when the environment and I guess the economic circumstances are there for the rand to strengthen, it does it fairly consistently over a fairly short period of time. Yeah. And so, again, we don't really get the headlines to say, whoa, watch out, the rand's suddenly stronger. That doesn't grab attention. What grabs the attention is the rand lost 4% today, and watch out, the world's going to end. And so I think from my perspective, worrying too much about the currency over short periods of time, it just is really a loser's game, because number one, we can't predict what the rand's going to do tomorrow. If the American president wakes up and is saying something interesting today for the world about stimulating the American economy or something, or the Chinese premier does the same, early tomorrow morning, we could wake up to see the rand at 14.90 to the dollar, and it would have been a completely unpredicted event that caused that to go up. Yeah. So if you're asking me my view on panicking about the rand, I think it's a waste of time, hugely energy consuming, and often leads to investment mistakes. I think you should peg yourself a level for the rand, and for example, for almost nearly, it's really close to 2 years now, Ray, I've been saying 15 rand 50 to me is the right level for the rand against the dollar. So if the rand is sitting at 15 rand or 15 rand 10, and you need to buy overseas investments, then by all means buy your overseas investments, because the rand is actually a bit better than it should be. But when the rand is sitting at 15.90 to the dollar, be patient, because the likelihood is it's going to come back to you. That doesn't mean that I'll never change my view. I just think we need to be careful that of the noise of the rand, because it is a noisy currency. It does move all over the place, but over a 5 or 10 year period, it does gradually decline against the dollar because our inflation is higher than theirs. But it can do it in wild swings, and so there will be times to buy dollars again. And now is really not one of those times to panic and just send all your money out because rand's weakened a bit. I think we need to understand why. It's not South Africa. It's actually a country north of our borders on the Mediterranean. It's called Turkey. And, unfortunately, their president is acting like a turkey, and it's causing a whole lot of issues. But those get washed out of the system again. And then, the environment is still favorable for the rand when the oil price in dollar terms is high. That tells you that the demand for commodities is there, and that's good for South Africa. So I would hate to predict the currency and say it's going to come back next week or next month, because then it'll do exactly the opposite and make me look like a fool like it's done before. But I'm not panicking about the rand now.
No, absolutely. It's 15.93, looking at what it is doing to the dollar at the moment. We're chatting to Warren Ingram about slow risk, and it may be a bit of a killer. It's like the junk food that you eat. Some of your questions, perhaps, 011-883-0702, or you can also SMS us on 31702.
The Money Show.
Personal Finance with Warren Ingram.
Right, talking personal finance and where to put your money, and talking about a slow risk. Now, Warren, I got a question for you. It's a listener question, actually. It says here, good day, Warren. My parents are part of the government employees pension fund through their employment, which I think is a good retirement plan. They also use retirement annuities and fixed deposits to save. Their plan is to retire in 12 years, and I'm worried that the fixed deposits will not give them the best return over this time. How can they best invest their money, and what type of investment should they consider? And that's from Mpho. Your answer.
It's a brilliant, must say, a brilliant question, because, firstly, just to expand a little bit about the Government Employees Pension Fund. It is underwritten ultimately by government. So when you retire from Government Employees Pension Fund, you actually get an old school, old-fashioned pension. In other words, they're going to say to you, when it comes to your time of retirement, they're going to say, okay, you've been working for us for a long time. You've been contributing to this pension fund. We're now going to pay your pension, as an example, of 40,000 Rand a month. And we hope and expect that it should go up with inflation every month for the rest of your life. It's something that you can kind of take to the bank, right? Because it's given to you by the Government Employees Pension Fund. And for those that don't know, that's a very big fund. There's a heck of a lot of money in there. But if that actually runs out of money one day and you're still alive, the government itself stands as the guarantor for that. In other words, it's Ray and me and every other taxpayer in the country, because we're paying our tax, and that's the money that goes to government, and that's what government will have to use to guarantee those pensions if something goes wrong with the GEPF. I'm not saying that it will, because I think the GEPF in most years and most decades is well managed. But what that means for someone who's retiring is they've already got a portion of their retirement money absolutely locked in and guaranteed. What isn't guaranteed is that their income might not increase at the rate of inflation. No, that's something that the GEPF will try to do, but that certainly can't be something that they will ever guarantee. If inflation goes crazy or stock markets collapse for 20 years, there might not be enough increases every year to match inflation.
Okay.
So if I look at this, and Mpho's concern, I think, is correct. Mpho's parents are already have a very safe investment in the GPF. So to then lock in some of their money into fixed deposits where they're not taking any risk and guaranteeing themselves a rate of interest might feel like a smart thing to do. But unfortunately, fixed deposits aren't great at giving you, inflation beating returns, especially when you take tax into account. And that's my concern here. They actually need to take some investment risk in productive assets. Yeah. And my view is, that if Mpho is asking what those look like, that could be something like an exchange traded fund, which just buys, the top 40 or top 50 shares in South Africa, or, a world index exchange traded fund. Something that gives them the ability to yes, they are going to take risk. Yes, it will be volatile. It will go up and down over time, but they've got enough time left to retirement, Mpho saying 12 years from now, that they can afford to take the risk and realize that once they retire, life isn't over. They're still going to live for a few decades after retirement. So they can afford to take the risk of investing in the stock market. And with their retirement annuities, I think that those are fine, provided the retirement annuities are low cost. They shouldn't be very expensive. And secondly, that the investments of those retirement annuities are largely biased to shares, so that they make sure that they are getting good capital growth. Because unfortunately, Ray, the way that they're going to buy their replacement cars in future, or, fix the house or the roof or whatever it is, any kind of ad hoc expense won't come from the pension. That's a monthly income. They need other capital that they can call on, at short notice, or, perhaps if it's a car, it might be with slightly longer notice, but they will need extra money, and that money does need to grow a lot faster than inflation. So they're going to have to take some risk, but then live with the risk, understand that it goes up and down, but over a long period of time. The stock market's a great place to be, when you've got a decade or two in your investment horizon. It doesn't lose money over those kinds of time frames.
Yeah, so it's actually interesting that you say that. There's an SMS that's come in and it says, how do you go into the market now at such a high? And I suppose the all share is over 70,000 and many equities are doing really well. But where do you go now? Is it just a case of careful shopping, perhaps?
The stock market's hit an all-time high, but I wish I had the numbers at my fingertips about when it breached that high before, because what we must never forget is, the infamous lost decade. We've had a long period of time where the stock market just hasn't been delivering growth at all. There was certainly a 5-year period in the recent past where the JSE didn't even beat inflation. And so just to understand that this all-time high, it's not as if we've been breaking all-time highs year after year after year for the last 5 or 10 years. We've really struggled to get any kind of return from the JSE that's been meaningful. So what's happening now is we're actually only starting to recover lost growth now. And my view is there are a lot of legs in the JSE. There's a lot more growth that can come from our stock market. So this all-time high is a little bit misleading. So my view is, if you've got a lump sum that you need to invest in the JSE, by all means, take that amount, divide it into 6, and then feed it into the JSE every month in equal parts over 6 months. So phase it in over 6 months. But if you've got a debit order, don't be afraid to commit that whole debit order into the JSE, consistently, because I think, I'm really comfortable the JSE can get, a lot higher from here before it becomes expensive. It's by no means expensive now.
Yeah. Another one here says, great topic, Warren. Learning a lot. I invest most of my money into my RA. Is it a decent investment compromise for an anxious investor like me? That's from Bulumko in Burgundy Estate.
So I love low cost retirement annuities. I hate the ones that are really expensive. So I've seen lots of retirement annuities offered by insurance companies that are, and I'm not saying the insurance companies old school, but the retirement annuities old school, where the fees are somewhere around 3.5% to kind of 5% a year, and that's going to be charged to the investor for the next decade, if not longer. And to me, those are really awful investments because, if your fees are 3.5% a year and inflation is running, let's say, at 4% a year, that means your investment needs to generate, at least, let's say, 7.5% a year just for it to stand still. And I think that's a very tough benchmark. So I love retirement annuities, but you really want them to be, the modern ones that are offered by investment companies where, you're not paying much more than, let's say, 1 to 1.5% a year. In which case, the tax benefits that you get from your retirement annuities are really good. One of the things people forget, Ray, is that, the money that you've got invested in an RA, it grows without paying any tax. So an RA itself doesn't pay income tax, capital gains tax, dividends tax. That's a huge benefit. Then we get all the benefits of contributing to our RA. So I like RAs. I think the anxious person there doesn't need to be anxious if they're in the low cost, kind of modern RA.
Right, in 30 seconds, our phrase for the week. What are debentures?
So debentures, nothing to be confused with dentures, which is the things we put in our mouth when we lose our teeth. These are debt instruments. So typically something that pays you a rate of interest every month, often offered by companies. They're nice because the company promises to pay you a rate of interest for a period of time. The thing to know, though, is that the company doesn't give you any security for that debt. So it's unsecured debt offered by companies in most instances. And so the interest rates are usually quite good, but quite risky if the company's not financially sound.
There we go. Warren Ingram, personal financial advisor and executive director at Galileo Capital. Warren, great to chat to you once again.
Thanks so much.